Good morning, everybody, and happy Thursday. It's Ticker Thursdays here at thestudytrader.com, and I'm Serge Berger with your Set the Market morning call. We are going to quickly see when people are logging in here. Oh gosh, you guys are all ready and set to go. Perfect. Thanks for being here. Can you guys hear me okay? Just quickly checking. I always like to make sure I'm not going to be just talking to myself. Wouldn't be the first time. Excellent. Perfect. Let's get started right away. Again, good morning, everybody. Serge Berger here from thestudytrader.com. This is our Set the Market morning call. Thanks for being here. We are going to spend the next 10 to 15 minutes going through some of the more important things on my notepad here. If you're here for the first time, please make sure that you subscribe to our channel. That gives you the ability to get alerted in real time when we go live with our analysis and when we have podcasts and other analysis. And of course, if you give us a thumbs up like on every video you watch and maybe comment here and there, that would help the algorithms to be able to pick up our show. Before we get started here, let me quickly give you a bit of a preview of what the top few things are that we are going to be looking at here together. We need to look at bond yields. I know it bores you guys, but I'm telling you, it's getting more and more important. So we do need to look at those quickly. We have a jobs report tomorrow, so we're going to be looking forward toward that. And then we are going to be looking at something really important, which is the MOVE index, which is giving us some signals here in conjunction with what's happening in the bond market. And then this is probably where you guys will perk up and watch. We'll be looking at oil and metals, gold and metals versus stocks, which I think is critically important to understand where we are on that here. So let's get started. I do want to make you guys aware of our latest podcast that just dropped, I guess a few hours ago. I don't even know when it dropped. And it is right here. If you guys go on your, in the YouTube channel here, and you check the latest video that was posted, I guess yesterday or whenever it was posted. I just put the link in the chat box as well. This is an incredibly important podcast. I mean, I tend to think most of them are important. This one's really interesting because what we're talking about is something called return stacking. I would urge you guys to watch this video, this webinar, it's not a webinar, it's a podcast with my friend Mike Philbrick from Return Stacked ETFs. He really does a great job. He's a super smart guy. So go ahead and watch that. I think it would be very beneficial for all of you. Again, the link is obviously on the YouTube channel, and also I dropped it here into the chat box here. So that's what's going on there. So first of all, let us talk about the bond market here first. So we continue to see this sort of monetary debasement where the dollar goes down and everything else goes up. I've shown this chart now for probably almost every day over the past a couple of weeks. And it's important to understand that if you're, and I shouldn't say you, although I know most people are in the same boat on this, people that are basically long the NASDAQ 100 as their retirement account, and if you look at the correlation of your portfolio, it most likely is a correlation of almost 1. It's not like those portfolios are making that much money. They are basically just flat with the dollar down. The S&P 500, I think year to date, is actually down quite a bit versus in euros, right? So if you're a non-US investor, the dollar getting pounded year to date has not been good for your US stocks. So we're seeing a lot more of the global rotation out of US assets. And you'll get your classic, talking heads on TV staunchly defending that that's not happening. I'm telling you right now, they're either lying to you or they're simply not looking at the right data. But it's very clear, we've talked about this now since I think April or so. We're seeing since a year now, a year and a quarter actually, where we're seeing the marginal outflow out of U.S. assets. And marginal. It's not an exodus. We're not talking the end of U.S. stocks. That's not the point. But you're seeing it. And again, it's the dollar. The current U.S. administration wants a weaker dollar, at least at the moment. That's very clear. And I get why, right? But it's coming. It reduces your purchasing power, and that's why you see something like gold and silver and so many of the other assets that we've talked about all year long. And again, I said it yesterday. I got some pushback because of my tone, but I'm telling you right now, it is critically important to understand where we are in terms of year-to-date performance. And the year-to-date performance is not in your Max 7 favorite stocks. It's not in all those chart chaser names. It's been in metals. It's been in hard assets. And while they're going to oscillate, it's not going to be a linear line. We strongly believe, and this has been our main call now for a year and a quarter at least, that hard assets are going to start to outperform the other stuff. And that's what's happening. Gold miners, we talked about it yesterday, probably getting a bit overbought. Gold, I don't know. I sold 2/3 of my gold in May or late May or early June. Can't remember when I talked about it here live. I'll look to add it back at some point before long. But right now, I kind of want to see what happens here in September, October. But again, keep in mind, this is what's happening. So that's the big picture point that I think we need to understand. Now, at the same time, and again, we have a jobs report tomorrow, which is why I think trading is going to be quite choppy. Next week we get inflation data, and the week after that, on the 17th of September, we get the Fed rate decision. In the meantime, what's happening is that we are seeing yields on the short end. So if you look at 2-year yields, finally break, or at least early this morning broke below 3.6%. I'm still long 2-year futures. I do a lot of my macro plays through futures. I just find it a cleaner way to be either long or short. But we'll see. We'll see how this ends. I mean, I wouldn't be surprised to see more oscillation. Again, I don't think it's going to be a straight line, but I probably will close my 2-year note futures position at some point early next week. I might hold it through jobs report tomorrow. But again, I think lower yields on the short end, right? So we have a yield curve steepener. And so the reason why small cap stocks are going higher is because they could be the beneficiary of shorter end yields going lower. The problem is that we have a yield curve steepener. So the yield curve itself is actually steepening. I can show you that here. If you look at the yield curve, and again, this is an extremely unpopular thing because people don't want to understand it. But if you look at the yield curve as it is right now, let me make this a bit larger so you can see this really matters to your stocks, right? What is today? So let's add today's yield curve. Today is obviously September the 4th. So you can see that the yield curve today, the blue one, it's steeper than what the yield curve was back in May and back in June, right? So basically the difference between 10-year yields and 2-year yields, which is the spread that I'm looking at here, is more. And that tells you that the market is pricing in risk of, because of irresponsible deficit spending. The US has a deficit spending of 7% budget deficit. We have a lot of money sloshing around the system. That's why stocks are still going up. But the bond market is telling us something very clearly, that the bond market is not happy with this. The currency market is punishing the dollar, right, because of that. And at the same time, we are starting to see the bond market get nervous. So I promised you before I would show you something called the MOVE index. And it's the squiggly line, the candlestick line. So the MOVE index, which is bond market volatility, is starting to perk up. It hasn't had a big perk up like this since February of this year, and I wouldn't be surprised if that at some point causes some volatility in the stock market as well. So again, for those people that like to just look at a few chart stocks intraday, this may not be that important, but even there, it could be important to understand what are the odds from a directional perspective more near term. So that's what's going on in the bond market. That's what's going on. Big picture. So a lot of this stuff is really more for your portfolio. For a portfolio, can't give advice. This is just educational here. But again, it's coming. The markets are speaking very clearly. Now, again, people haven't cared too much because their Max 7 stocks are still up a little bit this year. But again, I come back to the same thing I keep harping on, and I still see that most people don't care. Max 7 stocks are now up 11% on the year. That's good. But notice the performance disparity between that and pretty much everything else, right? So it's happening. The dollar is weakening. The yield curve is steepening. The bond market is voting. Bond market volatility is up. Yes, liquidity is still there. That's why stocks are still bid. But underneath the surface, the better performance is somewhere else. And we think that's just the beginning of a much longer term story. And so one thing I can show you, and I came across this chart yesterday. Someone, I don't know where this, you have to forgive me, I don't know where I got it from, but I look at these ratios myself all the time anyway. But you can look at something called the XME ETF. So XME is basically the S&P 500 metals and mining ETF. So it has a lot of mining stuff in it. And if we take just, so this is like if you know gold miners and that kind of stuff. Now the chart itself doesn't look all that appealing. I mean, you could see, yes, okay, we've broken out here, but this is such a long-term chart, I'm not quite sure it's that relevant. What I think is relevant here is if we take XME and we divide it by, let's say, I think the chart I was looking at, the XLK, which is the technology sector, the S&P 500 technology sector. And when you look at that, what you'll find is that this is a significant move that we're starting to see, and it could just be the beginning of that ratio starting to really mean revert. Again, we've seen gold miners up 80% year. Again, I think gold miners are getting overbought. We talked about it yesterday. If you guys would like me to show you the gold miner chart again that I showed yesterday, please type in gold miners or something into the chat box. I'll happily share it again if you want to see it again. But I believe, again, it's not going to be linear. I think these gold miners are going to come back down. But if the price of gold keeps going higher, then companies that are levered, right, gold mining companies that are leveraged to the price of gold are basically minting money, right? No pun intended. So that's what's going on. So we could see the ratio of gold mining stocks versus the S&P versus tech stocks, the tech sector. We could see that start to really go much higher. So again, this is the kind of stuff I'm looking. That's why our clients over at Blue Marlin Advisors, that's our investment advisory firm, that's why we are really focusing a lot more on being in real assets, hard assets, as opposed to financial assets, because we think that train has left the station. And again, it's more of a relative underperformance call that we're making, not a let's be short U.S. tech stocks call. That's not the point. I think that would be a bit of a stretch. Okay, so it looks like some people would like to see that gold mining chart again. So what I showed yesterday here is I showed the GDX ETF. So again, this is something we've been pounding the table on all year. Hopefully, I'm just hopeful and praying, quite frankly, that you guys were paying attention to this. When we talked about this early this year, or last year, or this year, we talked about it almost more than a year ago now, as I said before, that hard assets are making a comeback. And the chart that showed you gold miners or the metals versus tech stocks is kind of the ultimate way, I believe, in looking at that. I thought was a very good point of when I came across that chart. So gold miners up 90% on the year. That's a lot. I think short term they could be getting overbought, but again, I wouldn't want to get too cute. Now, can gold miners from here, drop to 30%? Oh, they definitely could. What I'm trying to show people is that the bullish trends are intact. But even if gold miners at this difficult level here, which I'll talk about in a second, if they were to drop 20, 30%, that would still be in a very bullish trend. The reason I think gold miners might be getting a bit overbought here in the near term, maybe that's a few weeks, maybe it's a couple months, I don't know, is really not that hard to see. It's just we have a level from 2011 when the gold market topped out back then, and we're now back at it right now here. So I think it's prudent to, again, not advice, just educational. For me, I haven't yet done anything, I haven't written any calls or call spreads here, but I'm looking at it and considering it. Before long, I might do it. I just think it's a price level that has memory, has history, that we might be able to kind of do a bit of an overbought trade there. on a situation like that. So that's what I wanted to show you guys on that. So we've covered the capital rotation, again, marginally as a rebalancing act out of U.S. assets. It's a long-moving story. That's not a 1 day, 1 week, 1 quarter. That's a multi-year story. But we believe it's happening. Again, everything I showed you here today between the yield curve steepening, the move index, the dollar lower, risk assets still bid, like all of that is essentially the same story. And I think most people are still unwilling to listen to it. So last but not least, I want to give you guys one thing that I thought was interesting, and that is in Apple. So this is now sadly where everyone's going to pay attention and forget everything I just said. But you know, here we are, gambling bubble is at maximum full force. But I did want to show you Apple. We're going to be talking about Apple as well in our trade-a-thon, which starts at 9:45 this morning. Here is the chart of Apple. I want to point this out. This is our momentum indicator. We received a momentum buy signal in early August, and that reached a free profit target. And with yesterday's break out of a 3-week range, it would seem probable to me that this is continuation momentum, that we could see Apple go higher. We have a trailing stop in place here, which is currently around 228 or so. But I just thought I would point this out in case anyone wants to know one thing that we're watching in terms of momentum on a single stock level. And that gets us to Ticker Thursdays. We've got not quite 5 minutes left. If you guys have any stocks you want to have a look at, please let me know. I'm here to take the stocks into consideration that you have to you would like us to look at. So please type in any stocks that you would like us to look at. We'll take a couple here in the interest of time. I have to prepare for our trade-a-thon in about 25 minutes or so. For now, we looked at the gold miners, right? Here's Apple. I don't know if there's any other stocks you guys want to look at or any other names. Is AI, is that an actual ticker, James, or is that just you're just mentioning AI? I need to know the company as well, if you don't mind giving us an actual company name. That would be helpful. Oh, C3, gotcha. Okay, yeah. So C3. I mean, look, C3 is one of those stories that I can tell you is classically where the AI trade is in our view. So what's going on with C3? Well, first of all, momentum is very bearish, right? So if you have our momentum indicator, James, this is C3EI, and this is our trend or momentum indicator. We received a momentum sell signal back on the 29th of July. You can see it reached a free profit target, and we're trailing it lower. So we currently have a trailing stop at $18.60-ish, right? So if it were to break above there, that would be something that would concern. But right now, I wouldn't be touching this from the long side. I don't see why. I understand that they tell a good story about the bullishness of AI. We think there's a much more bullish story in energy and materials for AI. And then one more, BMNR. Let's see, BMNR. BMNR, oh, it's a choppy one. Okay, so BMNR right now is bearish momentum. So you can see we had bullish momentum, and then the stock basically popped, gosh, like 70%. And now we are getting fresh bearish momentum, Octavio. And the free profit target currently is at 41.50 or so. The trailing stop around 47. So that's what we have here in BMNR. So hopefully this is helpful, folks. That's it for this week for Set the Market. We are going to be back Monday. I am on the road mostly tomorrow, and we will see all of you guys that are participating in our trade-a-thon in about 25 minutes or so, where we do our repeatable morning scan and our morning routine. So we'll see you guys over there, as well as in Trade Ops. Have a great day. Don't forget tomorrow jobs report, which could be moving the markets as we get into Friday morning. Take care, and we'll see you soon. And please subscribe to the channel. Thank you.